Hey guys, welcome to my fiscal policy mini lecture. I'm going to talk about what fiscal policy is, a few different do's and don'ts with it, and just, I don't know, a lot of side topics. When we're done, there's an end screen which will have links to a few of my videos which get into the more technical aspects of the model, because this video is just a verbal overview. So, what is fiscal policy? Fiscal policy is when the government changes its taxing or its spending to meet macroeconomic goals. Specifically, it's going to help us manipulate the aggregate demand curve. When we talk about monetary policy, we talked about how changing the money supply can change interest rates, and that'll move the aggregate demand curve left or right. Well, fiscal policy, we can move it a little bit more directly. By changing government spending, we can directly move the aggregate demand curve because aggregate demand is C plus I plus G plus net exports. Move G, move demand. And by changing taxes, whether it be taxes on people or taxes on businesses, you can change consumption and investment. Cut taxes, consumption and investment will rise, and that'll increase aggregate demand. And so with fiscal policy, we have two general ideas: expansionary policy, contractionary policy. Expansionary policy is cutting taxes or raising government spending. Both of those will increase aggregate demand. Contractionary policy is raising taxes or decreasing government spending. Both of those will reduce aggregate demand. Now in my class, we're going to focus on the default goal of stabilization. The whole reason we bother with fiscal and monetary policy isn't about growth, it's about stabilizing the business cycle. Growth is a separate issue usually. So we wanted to have counter-cyclical policies. If you're in a recessionary gap, you want expansionary policy. If you're in an inflationary gap, you want contractionary policy. That part feels very much like monetary policy. And when you draw it, it looks exactly the same in your ASAD model. Now these changes in government spending and taxes, some of them are discretionary, like we do them intentionally. Like, for instance, when we passed the CARES Act, that $2 trillion stimulus package after COVID-19 hit, that was its own separate legislation where the government changed things. So that's what we call discretionary. It's tailored to the situation and is a one-time change. There's also something called automatic stabilizers, which is an automatic form of fiscal policy. And those are policies that kick in without anyone actually having to tell them to. If you go into a recession, for instance, if unemployment starts rising, the government will automatically start paying people more in unemployment insurance, in food stamps, in Medicaid enrollment. It starts spending more money automatically when the business cycle has a downturn. And those are automatic stabilizers because it automatically does expansionary policy during a recessionary gap. Then later, when the economy recovers and we wind up in the upper part of the business cycle and in an inflationary gap, as we go there, more and more people go to work and those benefits start to phase out. We stop paying them unemployment insurance. They no longer qualify for food stamps, etc. Automatic stabilizers, they kick in. Now, when do we do discretionary fiscal policy? Because the automatic one, we don't have to control very much or at all. We usually do discretionary fiscal policy if the Federal Reserve has acted and is not doing enough, or maybe that's not even the right way to put it. For instance, they could hit the liquidity trap, the zero lower bound, and maybe monetary policy is now ineffective. But for whatever reason, monetary policy has run its course and the automatic stabilizers are working, but we're still in a recessionary gap. That's when we would put together a big discretionary fiscal policy package. Now, why do we let monetary policy go first? Well, it's faster than fiscal policy. It's enacted more quickly. It's run by economists who usually are more prone to jump on fluctuations in the business cycle than politicians are. Whatever reason you want to say. Now, one thing I want to say, because I've heard people say something that's kind of wrong about fiscal policy, during a recessionary gap, we will borrow money to do fiscal policy. Right? During a recessionary gap, tax revenue decreases because fewer people are working. And at the same time, we might be talking about tax cuts and or spending more money. So not only do we have less revenue than usual, but we're going to spend a whole lot more money. Well, we're going to be spending money we don't have. That means we're going to have to borrow money. We call that a deficit. Fiscal policy during recessionary gaps is done by deficit spending most of the time. Some people don't like that. They don't like that the government borrows money. I do want to point out, though, that economists do not advocate for endless deficits usually, because the opposite side of this fiscal policy stabilization stuff is that in an inflationary gap, you raise taxes and you cut spending and you go into a budget surplus. That's the recommended policy. You might be aware that that actually doesn't happen very often. In the last 55 years, there have been 5 years where the United States has had a budget surplus. The federal government of the United States had a surplus. 5 out of the last 55 years. So what economists recommend isn't necessarily what happens, but economists are usually not advocating for endless deficits. We would say deficits during bad times, surpluses during good times. And so with that, would we advocate for a balanced budget, like an annual balanced budget requirement? Most economists say no. The business cycle doesn't follow the calendar year. We want the discretion to have expansionary policy during bad times and contractionary policy during good times. A balanced budget amendment does actually the opposite. If you go into a recession, you lose tax revenue because people lose their jobs and stop paying taxes. So if you need to balance your budget and your tax revenue goes down, that means you have to cut spending. But that's a contractionary policy during a recession, which makes the recession worse. So rather than stabilizing the economy, it destabilizes the economy. During an inflationary gap, we pick up all this extra revenue because everyone is paying so much in taxes because they're making so much money. We would have to increase government spending to balance the budget, but that would increase aggregate demand. That's expansionary policy. It's going to increase GDP further and create even more inflationary pressure. A balanced budget requirement runs the risk of destabilizing the economy because it could make us do the wrong policies at the wrong time. Now, my last thought, I didn't make any videos on this part. I just think it's interesting. One thing you can wonder about is, what are you spending the money on? Some forms of government spending have a short-term benefit. For instance, increased unemployment benefits. That benefits our economy today, but has very little long-term payoff. Other forms of federal spending, say we're going to have more investment in infrastructure or in research and development, those can have long-term benefits and promote future growth, increasing future GDP. So if we're going to talk about borrowing money, a relevant discussion is, what are we borrowing money for? Are we borrowing it for something that's short-term with no long-term payoffs? Or are we borrowing it for something that will actually make us richer in the future? That changes the calculus about whether it's worth it to go into debt. If something has a future payoff, that debt is less burdensome than if something is only consumed today. At the same time, though, unemployment insurance is usually a better way to target your fiscal policy to get out of a recession than building a new freeway. It's faster, and the money goes right to the people who need it most. But anyway, I hope this was helpful to you. Check out the next videos. I made quite a few for this chapter, and a couple comparing fiscal to monetary policy to highlight some key differences. So, yeah. Thanks for watching, guys. Good luck. Happy econing. And I'll see you later.